Every year, millions of people hand the IRS a zero-interest loan and somehow feel proud about it. But what if playing it too safe is actually costing you more than you think? We're talking about estimated taxes, underpayment penalties, and the quiet financial trap hiding inside one of the most misunderstood corners of the tax code. Here's the uncomfortable truth. The IRS doesn't care about your cash flow problems, your slow quarter, or the fact that your accountant ghosted you in September. If you owe more than $1,000 at tax time and didn't pay in throughout the year, Uncle Sam is coming for you with a penalty and a smile. The whole system was built around wage earners who have taxes automatically withheld from every paycheck, clean, simple, and visible. But the moment you become self-employed, take on freelance income, sell an investment, or collect rental income, you've just graduated into a whole new game with quarterly due dates and a lot more responsibility. Think of it like a subscription service you didn't know. You signed up for the IRS, wants payments 4 times a year, roughly in April, June, September, and January. And missing those dates is like missing a payment on a loan with a very unsympathetic lender. The penalty rate is currently tied to the federal short-term rate plus 3 percentage points, which doesn't sound terrifying until you realize it compounds and it never forgives. Now here's where the psychology gets interesting. A lot of people actually prefer getting a big refund at tax time because it feels like winning, like finding money in an old coat pocket. But what they're really doing is overpaying all year, giving the government an interest-free loan while their own savings account earns next to nothing. The smarter play, the one CPAs whisper about at conferences, is the safe harbor method, and it's the closest thing to a legal cheat code the tax code actually offers. If you pay in at least 100% of last year's tax liability, or 110% if your income exceeded $150,000, the IRS literally cannot penalize you, no matter how much you owe in April. Let that sink in for a second. You could have a monster year, make 3 times what you made last year, owe a massive bill in April, and walk away with 0 underpayment penalty as long as you covered last year's number. It's one of those rare moments where the tax code accidentally rewards people who pay attention. The misconception most people carry is that estimated taxes are only for the self-employed, but that's dangerously wrong. If you sold stock, received a big bonus, cashed out a retirement account early, or collected unemployment, you may owe quarterly payments and have no idea. Another myth worth destroying. Some folks think skipping estimated payments and just paying everything in April is no big deal because the penalty is small. But at current rates, plus the fact that it's calculated on each quarterly underpayment separately, you can rack up a surprisingly annoying bill just from procrastination and wishful thinking. So what does history actually teach us here? Every market cycle, every economic shift, every tax law change tends to catch unprepared people the same way, not because they're unintelligent, but because they assume the rules that apply to their neighbor also apply to them. The disciplined move has always been the boring one. Estimate conservatively, pay on time, and hold the rest in a high-yield account until it's needed. The practical lesson, if you're looking for one, is embarrassingly simple. Start smaller than you think you need to. You don't have to confess everything to someone at a break room table. You can start by just not performing enthusiasm you don't feel, not sending the "ha-ha, totally fine" text when you're not volunteering "I'm great" before anyone's even asked. The discipline isn't in the grand gesture. It's in the small, daily decision to occupy your actual life instead of a curated version of it. What we're really talking about here is the discipline of treating your tax obligation like a bill. Not a surprise, because the people who never stress about taxes aren't lucky, they're just organized. Process beats prediction every single time. And the same emotional detachment that makes a great investor also makes a great taxpayer. At the end of the day, the question isn't whether to let the IRS hold your money or keep it yourself, it's whether you've built a system that keeps you protected, penalty-free, and in control. Whether you end up with a refund, a small balance due, or a perfectly zeroed out return, the win is in the preparation, not the outcome. And if you want help building that kind of financial foundation, whether it's real estate investing, home contracting, work, or finding the right lenders, check out our links in the description below.